Investing 101 today is focused on ETFs, exchange traded funds. An ETF is a basket or several stocks that are similar. Noah Rubin, a managing director of investments at Wells Fargo Advisors, is joining us for that. Good to see you there, Noah. How are ETFs more beneficial than investing in, say, a single stock?
So bad things happen to single stock good companies. You could spend time researching, looking at companies' profits, future potential products, and decide it's a really good company. And so you make that investment. And the next day, that stock price could go down for one of 100 unexpected reasons. Maybe there's a fire in the warehouse. Maybe somebody gets hurt using the product. Maybe the CEO has a scandal. Maybe a competitor comes out with a better product that you didn't expect. There's 100 reasons why something bad could happen to a good company. The resolution is to use an ETF within that sector. So in that ETF, you will own the company. And if they do well the way you expect, you'll make money. But if something bad happens, you'll own their competitors and you'll be diversified enough so that hopefully it will lighten the blow and you can make money nonetheless.
Are there any caveats with ETF investing?
I would give you two warnings. The first is on those called leveraged ETFs. It makes you think that you can get 2 or 3 times the profit potential. And while it seems that way, in reality, it just doesn't work that way. If you're a professional investor, if you're very experienced, okay, maybe leveraged ETFs should be used. But if you're the average investor, I encourage you to tread very lightly when it comes to leveraged ETFs. Another caveat is these steam trendy ETFs. It happens all the time now. We'll all see something happening in the economy and we'll say, hey, we want to profit from that. Here's a silly, not real example. Let's say we find out nobody's buying birthday cakes anymore. They're buying birthday cupcakes. Somebody will open a birthday cupcake ETF. We'll all invest in it and hope to make money. Now that's silly, but there's a lot of silly ones out there. And because of lack of liquidity, lack of transparency, lack of available investments, most of the time when you invest in these thematic, very niche ETFs, you're not going to have the experience that you expect.
What are some ETFs that are performing well or not so well this year?
The takeaway when learning about ETFs is they're going to do what the markets do. They're going to do what the sectors do. Right now, effectively, everything is down this year. So effectively, every ETF is down. And doing what the markets do is bad or good, depending on who you are. If you're an active investor, if you're looking for home runs, if you think you can really outperform the markets, then you probably don't want to be in ETFs. But if you're the average investor and you're planning for your retirement, saving your nest egg, you sort of want slow and steady, singles and doubles, fully diversified, then ETFs and accepting to do what the market does is okay. Because, even in a down year like now, at least historically, every time the market goes down, a diversified portfolio goes back up.
Thank you, Noah. We look forward to having you back on our show.
My pleasure. See you soon.
Go to businessfirstam.com for where to see our show on TV.